G'day, guys. Welcome to the Thunder from Down Under podcast. I'm your host, Graham Solomon. And remember, if you're watching on Facebook, smash the like button, the heart button, give us some love, and go to the Graham Solomon Thunder from Down Under YouTube channel and hit the subscribe button, hit the bell icon so you get notified when we've got special guests like we have on at the moment. And this is a special guest because Dohn Thornton has been on the program before. He he specialised for 20 years in short sales, but he's actually coming on today to talk about something completely different. And I think everyone will love this topic. It is about what he's learnt in tax minimisation and a whole heap of other things about saving your hard-earned money. So I'll introduce you, Dohn, to the audience. Thanks for coming on again. This is your second time, so I appreciate your time. And you're on for a different reason this time. You've expanded your business into some stuff that you've learnt, which I guess the big heading is tax minimisation and getting the most out of the money that you earn. So, yeah, do you want to just start off, Dohn, by just basically saying how you sort of transition into this and how you, I guess, learnt your lessons and have formatted something that's really exciting for people as far as saving, not having to pay as much money to Uncle Sam, I guess.
Yeah, absolutely. In fact, later on you're going to put up or you may have it, you see it right now on my website. It's to hell with the IRS, and that's a heartfelt sentiment on my part. I don't, it's as someone who regrettably was spending way too much money on taxes in my 20-year career as a real estate investor. I was a little chagrined when I realized how much of an idiot I was, but I didn't know, and most people don't know. This last year or so has been a journey. And especially the last 2 months when I really started to promote this, at first as a client and then now as someone that, this is what I offer as my services, it boggles my mind that one person I've spoken with in 2 months, and I'm speaking with millionaires as well and gurus, real estate investing gurus, nobody knew about it. And so I thought to myself, well, I'm not such an idiot as I thought I was. So there's some validation there.
So, Dohn, is it a thing that people just get too busy and this is one of the last things that they do, that they just don't research it enough? And once, like what you've done, and you've seen something and researched it, that you actually find that there's perfectly legal ways to minimise taxation.
Yes, and I would say it's from the cabal of tax attorneys and CPAs. And I don't mean that in a bad way when I call them a cabal, but kind of sort of do. Because, it's not their fault either, because a lot of them don't know it as well.
Yeah.
It's like they are trained in their profession to do things a certain way. CPAs, tax attorneys, they're going to tell you what they were taught, and most importantly, they're going to tell you what makes them money, right? Okay, so think about this. Think about if you're a buy and hold investor, and first of all, full disclosure, if you're a wholesaler or if you're a real estate investor and you're doing, a couple deals a year, this is not for you. Okay. This is for people that are actually making money in real estate, have a medium to a lot of properties, a lot of doors that they're buy and hold investors. That's who this is geared to. So remember, I got into this after I've been doing this for 20 years, and I was flipping 50 to 70, if not more, short sales a year for a lot of years. So this was very much something that was near and dear to my heart, especially when I was cutting those checks out every year. So know that going into it. But if you're still at a lower level, keep this in mind, because when you do start making really nice money, you're going to want to do this strategy. Okay. But yeah, that's that. It's just, I think that they're taught a certain way. And so let's look at a buy and hold. So you're taught by CPAs, attorneys, tax advisors that you want to do use LLCs or use land trust or holding companies, or what usually happens is a convoluted, totally unnecessary way of taking title to your properties and holding them. And it's all done for the sake of tax limiting your taxes. And a lot of it is for asset protection, and some of it's for anonymity, not to know who your person is. But those are the really big reasons. Think about it. Every time you do an LLC, every time you file a tax return, all these things that have to do with your taxes, you've got somebody in your pocket You've got your accountant, you've got your tax lawyer, so all that stuff you're paying money every time you set up another LLC, you're paying all this stuff. Okay. It's completely unnecessary. So if the tax advisors do not have a financial incentive to help you, they're not going to share it. But I don't think it's because they're bad. I don't think they know about it. And the ones that do, well, they would lose a lot of fees. So there's no incentive on their part to not share it with you. So that's the kind of way it works out, that it's always done this way. So why change?
Can we go into, look, for the people that know you, you've got a lot of stuff on YouTube and that. You talk about the 1031 exchange. You've got a video on YouTube about that, and better ways to do it, because you're not a big fan of that. You seem to think now.
I'm not at all.
You seem to think that there's better ways to do it than a 1031. Do you want to just explain that?
Yes, absolutely. Without going into great detail, a 1031 exchange is done when you have capital gains tax. You want to avoid capital gains tax. And that means you're going to have you hold an entity or an asset for over a year, and then you sell it, right? So it's going to be capital gains owed on that. And I forget off the top of my head, I think it's like 20 or 25% of capital gains is what you're going to hit on that. So, this can be a lot of money. Think about if someone has a multiplex, right? And they've had it for a while, and for whatever reason, they decide they want to sell it. So they put it on the market, and let's say for 2 million, 3 million, 5 million, whatever. If you look at that, that's a heck of a lot of money that's going to be paid in capital gains. So again, people only know about 1031 exchanges. So they think, okay, got to get 1031 exchange done. I got 60 days to find a property that's comparable, and I got 180 days to find it. And if it's not an exact match, I owe taxes on what's not matchable. And so there's a lot of pressure, and you're most likely going to get hit anyway. And in today's market, with how hard it is to buy properties anyway, it's convoluted and unnecessary. The strategy that I'm using, that I'm promoting, is you don't need to do a 1031 exchange at all, because capital gains taxes can be deferred in perpetuity. So you can one entity, your trust, owns all of your properties. You can sell it like normal and not worry about capital gains because you won't pay it. You there?
But this is a bit of fun. I don't know whether
I don't know what's going on. You froze on me there. So
I don't know what's going. There's been a storm here. The last two podcasts I've done a bit, but we've got through it. I think it's come back now. But so with that,
yes, we're good now.
Yep. I think that just bounced. So we're back on. We're going all right. But
Yep.
So what you learnt with how to minimise the capital gains, obviously that would have been through trial and error, would it? You've just stumbled across.
No, actually, there's. Yeah, well, let me tell you the backstory. Okay, so I had a person who's now my partner. He approached me and said that I was doing it all wrong. Okay.
Right. Okay.
And I mean, honestly, I haven't heard that since my honeymoon. So it really kind of shook me a little bit. So he said that I was paying too much in taxes, and that everything I was doing was too much. I was taking my properties and land trusts, and I was selling them, and it was ordinary income, and I was just paying too much on my taxes. He said there's a better way. He called it the Rockefeller way, because it's the way the oligarchs and the really, really rich people back in the late 1800s and the 1900s, they all use the same strategy, and it's not really well known outside their very, very small inner circle. Yep. And so they, so basically, I'll give you the nickel tour. Okay, as an investor, I will set up a beneficial trust. All right. Personally, and my business, we're going to sell our assets to the beneficial trust, and I will make myself the trustee and the beneficiary of that trust. There are certain tax advantages by using a beneficial trust. There's also a hell of a lot of asset protection provisions in there that make it amazingly simple and effective.
Mm.
The issue is that because of these tax advantages, I cannot operate my business and generate revenue from the beneficial trust. So what I do is I open a business trust with myself as the trustee again and the beneficiary. And then my beneficial trust is going to lease all my assets to the business trust, so the business trust can operate those assets and create revenue, right? So the way it would work is I go through and I run my business the entire 12 months or whatever fiscal year you use in your accounting until the end, when you calculate what your gross revenue is. You take your normal take your normal what's the word I'm looking for? Normal deductions and expense everything out, right? So let's say that I had 1.5 million in gross revenue, and I ended the year with $1 million as my net revenue. Okay. Now, remember, my beneficial trust leased the assets to the business trust. So now the business trust has to pay the piper for those assets. So the business trust pays 70% of the net income back to the beneficial trust. So if I had $1 million, 70% of that is $700,000, right? So $700,000 goes back to the beneficial trust, which leaves $300,000 as my new net income for the year. But there's one more trick that you can do with the beneficial trust. The beneficial trust, when we set it up, is also made a 90% limited partner in the business trust, which means that when we reduce that net income down from 1 million to 300,000, 90% of that is going to go back over to the business trust, the beneficial trust. So 90% of 300,000, that's $270,000. That now goes over to the beneficial trust, which leaves my business trust with only $30,000 in taxable income. So you can imagine the difference of the IRS calculating how much I would owe on $1 million as opposed to $30,000, right? So you're not going to pay very much in taxes at all. So now that we've gone through our tax year, we've generated our income, 90% of it, or more 90% of it, has gone over to the beneficial trust. Let's talk about the beneficial trust tax liability. There is none. Okay. Here's the reason why. The beneficial trust can defer capital gains in perpetuity. Never pay them. If you have the lease agreement, okay, so the lease agreement for the assets, remember that $700,000 went over. A lease payment is passive income. There is no passive income that has to be paid. It's all deferred in perpetuity. The 90% limited partnership, which the beneficial trust got $270,000, that is a K1 distribution, also no tax. It's all deferred in perpetuity. So that's that setup and how you run this. There's no taxes. So if let's say you have a multiplex and you sold it for $3 million and let's just say for the sake of brevity that you were going to have to pay $300,000 in capital gains. If your beneficial trust owns that, okay, and then you sell it and that money comes back in, that $300,000 is capital gains, but because it's through this beneficial trust, there are no capital gains. It's deferred in perpetuity. So, I mean, imagine that as a multifamily, as a buy and hold investor. Imagine that you never have to worry about paying that big money out in capital gains or trying to worry about a 1031 exchange. It's just, you don't have to anymore. It's just so simple. So simple. And that's just the tax part of it. Now, the beneficial trust has what they call a spendthrift provision. And this means that the spendthrift trust has been around for centuries. Okay. It has been, it's now settled law with the IRS obviously not the IRS, the Supreme Court, that it cannot be penetrated at all by any lawsuit. You can't put liens on it. You can't put encumbrances on it. And it's been tried multiple times. Every single time the Supreme Court has said, this specific kind of trust is, you can't touch it. So now, I mean, for me as a short sale investor, I was carrying a $2 million liability policy for my business because in case someone slipped and fell, or say a contractor fell off the roof, and so forth, it's crazy. So you don't have to do any of this other stuff that's convoluted about trying to do stuff like, for example, opportunity zones, things like that. Oh, you could do it for 5, 7, 10 years or whatever. You don't have to do that. You just put it in a trust and you buy and sell as normal. And it doesn't, you don't have to put it in some zone for 5 years or 10 years or whatever. You just put it in your trust and that's it. You never have to pay capital gains. Never have to pay, if you're a renter, if you're a landlord, your rents are passive income, no tax, deferred in perpetuity. So it's by far the most brilliant yet simple way to minimize your tax liability and to make it easier to work as an investor and protect your assets.
Yeah, amazing. That last 7 to 10 minutes is just amazing because it's simple. So you're saying that basically you just have the 2 trusts. That's all you have to operate out of, the 2 trusts. You don't have to have multiple LLCs and corps and stuff all over the place.
One tax return, one EIN number. That's it.
Yeah. And it just sounds so simple, doesn't it? Like, as you explained that, a layman like me could understand it. It's like, wow, that's very simple the way you've explained it. And no wonder the Rockefellers have got plenty of money if they're using that strategy.
Right.
You know what I mean? Like, it makes sense. So the way you explain it with how it works, perfect sense. So
the Rockefeller family, they started a beneficial trust in 1914. It still exists. It still works. They have 335 family members in there. And this is the 4th generation, I think. They're getting close to 5th generation. And it's there because it works.
There's probably people listening to this or listen to the replay that'll fall off their chair. And was it the same with you when you come across this? Did you think this is just too easy? And why didn't I know?
I thought it sounded, the typical thing was it sounds too good to be true.
Yeah.
That's really what was that was the reaction I had. And then, because it came from a trusted person, and frankly, he sat me down and talked to me about it. And I realized, yeah, you're right. This is amazing. Crazy. Yeah. What was I doing? I didn't, it just, it was crazy. So, but, I know that for me, I had to dumb it down as much as I could. And I put it in the context of me as an investor. I said, okay, so I'm doing this. So I'm flipping these houses. I'm not holding them for over a year. So therefore there's no capital gains, but I'm paying through the nose on ordinary income. And I'm being very aggressive with my writing my stuff off onto houses, which, it's kind of like you really ought not to do. It's all designed to lower my tax liability, right? And it still wasn't working. I was still paying taxes.
Yeah.
So now I sleep so well. And just as a reminder, guys, you can put all of your properties in one trust. Okay. One trust, every single property. You can have 2 properties. You can have 200,000 properties, one trust. Right.
Wow.
That's
because
it.
Like you said, it's just the tax minimization and that it's the asset protection. Like you said, you can have the asset protection there as well. Because one of the ways a lot of buy and hold investors do it is have the corp, and then they have each property has an LLC. Well, that creates a lot of extra work, doesn't it? Whereas you're saying that they can all be in that pierced. It can't be pierced as far as asset protection. So, that's amazing as well.
Now do you see why accountants and attorneys don't like us?
Yeah, because it's cutting them out of
creating
all these LLCs and all this revenue.
You don't need it at all.
Hopefully there's not too many watching. They don't get onto it. Hopefully they just wake up one morning and they're very quiet with their business. So that's amazing, Don. I mean, you just explained it so simple too. And that's what we like. We like to keep it simple. And
right. Oh, and just, if you don't mind me adding, I do this personally as well. So that means that my personal assets are also protected.
Okay.
So I don't. And so what happens is if you and people sometimes people ask, well, how do you get your money? Well, first of all, because I'm trustee, any legitimate expenses for the trust is paid by the trust. Obviously, I'm the one writing the checks because I'm the trustee. So really, the only things I have to pay for out of pocket that I would need to have other income outside of what the trust provides is for food, fashion, and fun. Food, fashion, and fun. Okay, but even then, I have a T-shirt that I wear wherever I go out, and it has "I don't pay capital gains." On the back, it says "F the IRS." Right? So I can't tell you how many times I go out and people come up to me and ask me about this. And so if I go on a trip, for example, let's say I go to Atlantic City and want to gamble, right? I wear that on the plane. I wear it at the casino. People come up to me asking information. I get in my car, I get their information. That's a business trip, folks. That's all. That's deducted, right? So you can see how that works. If I wear my shirt, it's pretty much anywhere I go or whatever. I'm doing business. That's my advertising. But stuff that isn't covered, well, when you sell your assets to the trust at the very beginning, you create a demand note. Okay, so you take your fair market value minus depreciation, and that's a demand note that I can draw upon anytime I want to get cash if I need it. And it's a non-taxable event. No taxes. I don't pay there's no W-2 taxes, no Social Security, none of that stuff, because it's not salary. It is a non-taxable event. This whole system is designed so that no taxable events ever occur. And that's the beauty and the simplicity of it.
Is that why you're in Vegas so many times? You got the extra money to go gamble and to wear the shirt. So I was wondering whether
actually, I went to Vegas. I went to Vegas to go to some events for millionaires, so I get this in front of them because the millionaires love this. It's just I mean, I might as well be talking dirty to them. They love it.
Oh, so that's what I'm saying. Most people think about it as a boring topic, but when you start talking about the savings that you're talking about, people get excited. All of a sudden, people are pumped up over tax minimisation and asset protection, and all of a sudden, like you said, it becomes sexy.
We can probably talk about this at a different time, but there's a third part of this that's even more exciting. You can take that $970,000 income that you're pulling from the business trust back to the beneficial trust. You can use a lot of this stuff, or a significant portion of that money. You can put that into a whole life policy that has unlimited growth, and then you can put that in there, run it through the policy, and then you can take out policy loans, and you can use that for investment and anything else. And again, it's all tax-free money.
Wow! So there's a third benefit.
There's a third component I really don't get into about that, but that's a third component of it. I'm mostly just talking about the tax savings and asset protection from real estate investing. But that thing takes it into hyperdrive as far as how much money you can make, because you're creating wealth at that point. You're putting just wealth that just grows and grows and grows, because that benefit keeps. It's like we call it a vortex effect. So I don't, usually when you say the word vortex, I start to glaze over. And you're like, I really won't get into that too much. I can tell you this. Okay. I just repeat myself. If you're not currently a buy and hold investor that has a lot of properties, and when I say a lot, maybe 5 to 10 or more, okay, probably you're not going to be ready for this, but you certainly can, right? It's just the more money you're making, the more taxes you're paying, the more properties, the more transactions you're doing, the savings compounds, right? But if you're flipping, right? If you're flipping, that's all ordinary income. If you're doing, if you're doing 10, 15, 20 flips a year, then you're on the border of probably would want to do this as well. There's an investment to it, of course. It's not for free, but you get it back so quickly with the amount of taxes you're going to save. So it's awesome. It's a great. I have never regretted it getting involved in this project. And that's why I'm promoting it like you wouldn't believe. And also, guys, I'll be honest with you. I mean, I have people that work as my affiliates that go out there and get this in front of, because my whole goal is to get this out in front of as many people as possible, because there's so many investors that need it, and there's only so much I can do. There's only so many podcasts I can be on, right? So anyway, that's
that's great to include other people out there, get the word out there. You don't think you're going to be on the hit list from the IRS, do you? They're not going to do a whack on you once
It's all perfectly legal. It's all
Yeah.
perfectly legal. If you want to, there's the IRS code 643 specifically has to do with these kinds of trusts and the fact that it is non-taxable events as long as you don't create a taxable event. Okay.
Yep.
Just be careful about how you run your money. Just follow the scenario, like I said, and then you don't take money out as a taxable event. And as long as you follow the rules, then there's no taxes.
Yeah. And how do you advise to set this up? Is it, certain people you'd go to that would know about this?
No, you come to me.
So that's what I'm saying. Like, so
Yes.
you can set it all up. Like if someone like me
Yes.
just say, Don, how you going? I want to set this up.
Yes.
You're the man to
Yes.
come to. So
Absolutely.
don't need to
We'll
go
get
to
you going.
CPAs. Don't need to go over here.
No.
You're the man.
We'll do a financial mapping for you.
Yep.
We'll go through and see what you've got and show you exactly how we're going to do it. We're going to set your two trusts up. And then once you get into it, you're probably going to want the life insurance too, because it really makes a huge difference on how much non-taxable money you have available to invest and so on and so forth. So basically, yes, you come to me and my company will do it, and we'll get you set up.
Would this be good for a young person that's got, say, 3 rentals that they want to build a big portfolio? Would they jump in at, say, 3 properties, get it structured, and then they'd be able to minimize their tax as they buy
if they have the investment, then yes. It's always better to do so.
Yeah. And they may
and by the way, the life insurance does not have to be on you. I have a stage 3 kidney disease. I cannot get I can't get a life insurance policy, so I put it on my wife.
Yeah. Yep.
Whoever has a life insurance doesn't matter as long as the trust owns it and the trust is a beneficiary. That's all that matters. It doesn't have to be on you personally.
Yeah. Wow, that's just a whole heap of information but it sounds very simple. And Don, I mean, you've got the website there, which is pretty easy to remember. https:// to hell with the IRS.now.site. So that's where people can reach out to you and contact you about this.
And yes, I run a live webinar every Thursday night at 7 Eastern.
Yep.
You can get a link on that website and just go there and register, and I can go over this in much more detail, answer all your questions. And plus we're offering a free bonus worth $2,500 if you come and stay till the end of the webinar.
Yep. Okay. And there's people can reach out also if they're fairly keen with an affiliate, that you're prepared to do some sort of affiliate thing if people join up and spread the word.
Yes.
So that's fantastic, Don.
Contact me if you're interested in the affiliate program. I'd be glad to set you up as well.
Yeah.
Because it's a very profitable endeavor. I can tell you that right now. And it's not for, I mean, it's for people that either already have a big portfolio or want to invest in setting their structure up correctly at the very beginning to make sure that they start saving right away. And as they grow, they don't have to worry about more and more taxes or trying to, spending more and more money, taking title to properties in a way that is not necessary, because it's just not necessary. Like I said, if you take one thing from this today, you just remember LLCs, land trusts, holding companies, all this maze of stuff is unnecessary. You don't need it. It's just a pain in the butt, and all that paper that's being produced by your accountants and by your tax authorities or whatever, it's not necessary. One trust, one beneficial trust, and one business trust working in concert will take care of all of that. And like I said, there's no limits on how many properties you can have. There's no limits on the capital gains that you get when you sell your properties over a year. It's all deferred in perpetuity. It's that simple.
Yeah, boom. You've heard it here. You've had a lightning bolt to the head. That's amazing. So anyone that's watching live or watches a replay, go over it again. because that just is amazing. And go and visit Don's website that's on the screen now. You'll see it there. We've mentioned it before. And book in for the webinar. Find out more information. Find out how this can create wealth for you moving forward. It's been some good times the last couple of years, so take that wealth and move it forward. So that's amazing, Don. I'm really, really wrapped that you've come on and shared that with everyone, and I hope a lot of people.
Well, Graham, I appreciate you having me on because it's it's great that you when I reached out to you, you recognized immediately this was
definitely.
So
anything
that's awesome.
And this is what we do. We try and get cutting edge products and services and things that can be beneficial for investors. And like you said, get into it. And even if you want to get some affiliates and spread the word, get an affiliate link and spread the word. So we're all for this, Don. This is something that is, like I said, generally not a topic that people get pumped up about, but the way you explain it and the way that you can save money, people's eyes open up and their ears. So it could be the new Las Vegas, type atmosphere of a topic that's usually pretty boring. So no, I appreciate you coming on, and you explained it very simply. I mean, like, I'm a layman and I got what you were saying. I understood it completely, and it just cuts a lot of red tape and a lot of paperwork and a lot of costs, and actually creates more wealth for you to move forward and use in your investing. So it's amazing. So thanks for coming on. That was good. It was short and sharp, straight to the point. Now, the other thing I wanted to ask you, Don, before you go, a lot of if someone, any listeners or viewers are watching that don't know you, you've got a pretty big YouTube presence. What's your YouTube channel?
My YouTube, just look, Dohn the Short Sale Guy. That's about my short sale business.
Yeah,
I started another YouTube channel recently, so it's not built up as like my short sale channel is, but it's Dohn the Infinite Wealth Strategist.
Okay, there you go.
Okay, that's just look that up, and I've got about 10 videos I think up there so far. Oh, and those of you who have Roku, if you have Roku TV, you can also find me. I have a Roku channel. You can find the same thing, Dohn the Infinite Wealth Strategist or Dohn the Short Sale Guy. Those are there. So go ahead. Whatever platform you want to consume them on, the content's there. The webinars are every Thursday. And, I'd be glad to, for those of you who are interested in the affiliate part as well, reach out to me. I can send you the information about that. I've got a Facebook group for that I teach, I train and teach my affiliates on how to do this. And, everybody can win. I'm trying to make it a win-win as possible.
Yeah. There you go, guys. Do yourself a favor. Go and watch some of the content. But it sounds like to me, go and watch the webinar because you'll get more out of that of a Thursday. You'll get more information, and Don will dissect it and he'll explain it. So it's probably best. I mean, you can watch a couple of the videos on YouTube, but go to the webinar, check it out, and then reach out to Don. I mean, like I said, he's crushed it for 20 years in the short sales business. Now he's in this industry and he's crushing it in this as well. So reach out. As you can see, he's very personable. Have a chat with him and get involved, guys. Get involved and not only make more money, save more money. So it's a great concept. And thanks for coming on, Don. And
Thank you.
As per usual, when Don comes on, he drops some thunderbolts. And as we say, thanks to Dohn Thornton coming on and dropping some thunderbolts. You guys have been thunderstruck. So we'll catch you later. And thanks again, Don.
Thanks a lot.